Investor letter language. Inflation and rates. Wording done right. Welcome. In markets, words move money. Investors read between the lines. They infer confidence, caution, or confusion from your phrasing. A small wording shift can change perceived risk, nudging decisions on allocation or timing. Say volatility may increase and people hedge. Say volatility will spike, and they panic. Clear, specific terms build trust and reduce legal risk because they show you know the data and the limits of your knowledge. Precision isn't about sounding fancy. It's about being accurate, fair, and useful so your audience can act with confidence. Anchor your message in current data plus its direction. Is it rising, steady, or slowing? Distinguish headline inflation, all items, from core inflation, excluding food and energy, because policy often tracks the core. Replace vague adjectives with ranges. Instead of high inflation, say headline at 3.2 to 3.4% year over year, core easing to 2.8 to 3.0%. This makes your view testable and timely. If momentum matters, add a monthly angle. Core cooled 0.2% month over month, a second consecutive slowdown. Clear numbers let investors compare against targets and price expectations. Use language that reflects nuance and distance from the target. For example, inflation is moderating, but above target. It signals improvement without declaring victory. Capture differences across the economy. Price pressures remain uneven across sectors, which prepares listeners for mixed earnings and policy responses. Avoid absolutes that overpromise, like inflation is under control. That sounds final and invites credibility risk if a hot print lands next month. Instead, pair data with risk. Disinflation is progressing, but services remain sticky, keeping upside risks alive. Balanced wording guides realistic expectations. Rates aren't one thing. Specify the instrument: policy rate, 2-year yield, 10-year yield, or credit spreads. Then link the move to a cause: data surprises, central bank guidance, supply, or liquidity. For example, the 2-year rose on stronger payrolls. The 10-year was steady amid weak supply. Separate the level from the path. Higher today versus higher for longer. They imply different positioning. Clarity here avoids talking past your audience and helps them map macro shifts to duration, curve, and credit risk. Ground your statements in observable behavior and risks. Try: the Fed signaled a data-dependent stance, which highlights conditionality. Explain curve shape and implications. The yield curve remains inverted, pressuring banks, since funding costs can exceed loan yields. Avoid crystal ball claims like rates will fall soon. That's an unsupported forecast unless you specify the trigger. Better: if core inflation continues to cool and growth slows, cuts become more likely in Q1, Q2. This frames a scenario, not a promise, and keeps you credible when the tape shifts. Use evidence, not certainty. Words like likely, points to, suggests, show humility while guiding interpretation. Attribute to sources so listeners can verify. According to the CPI report, Fed minutes indicate ISM services softened. When causality is unclear, flag uncertainty and offer scenarios. If energy stabilizes, headline should ease. If it spikes, expect a temporary reacceleration. This avoids hindsight bias and prepares your audience for alternative outcomes. Credibility grows when you show what you know, what you don't, and what would change your mind. Bridge the macro view to positioning. State actions versus watch lists clearly. What you're doing, why, and key risks. Example: initiating a modest tilt to quality credit. Spreads compensate for default risk while growth slows. Risk: a re-acceleration in inflation. Quantify exposure and horizon so sizing is clear. Target 2 to 3% portfolio weight over the next 3 to 6 months. If you're waiting, say what would trigger action. Add duration if core prints below 0.2% month over month for 2 consecutive months. This turns analysis into decisions, not commentary. Be explicit and testable. Define terms, timeframes, and sources so your audience can verify and compare. Stay precise, probabilistic, and transparent. Favor words like likely, range, if-then. Prefer ranges, drivers, and scenarios over bold claims. Example: core at 2.8 to 3.0% and cooling. If labor softens further, cuts become more probable. This style builds trust, reduces legal risk, and helps investors act. Remember, tight language, clear data, and honest uncertainty beat confident guesses every time.